Thanks everyone so far for joining. We do still have some registration numbers still ticking on at the moment. So we'll just wait another 30 or 60 seconds and then we'll kick off. Thanks for everyone that's joined so far. All right, the numbers are still getting up there, but we'll have a start anyway. The boring stuff is me to begin with, so those who aren't on yet aren't going to miss out on too much. So look, thanks everyone for joining. My name's Adam Clark. I'm one of the sales leaders at Equifax, looking after our market development teams. Thanks everyone for joining our next commercial webinar for 2025 to share our data-driven insights. We do have a lot of new people joining today's webinar as well, so hopefully you'll find good value from today and provide you with information that you need to help you work smarter and to help you make better business decisions as well. Our speakers today, we've got Brad Walters and we've got Dave McCulley. Brad's our GM for commercial services at Equifax, and he's going to run through the latest insights, and that'll be followed by Dave McCulley, who is our head of commercial solutions. We will have a Q&A at the end of today's session, so if you have any questions along the way, you will see a little box down there somewhere for the Q&A area. Send as many questions as you got through. We will aim to get through as many as we can at the end, please keep in mind as well that we'll also have a survey coming through at the end of today's session to your inbox. So we'd love to hear your feedback, love to know if you would like any more insights. And if you have any further questions on that you may not have thought of on today's session, you can feel free to add that in there as well. So look, enough of me, we'll jump straight into it now. I'll pass you over to Brad Walters to kick us off. Over to you, Brad.
Thanks very much, Adam. Welcome one and all. We've got an action-packed update to share on the latest insights and some of the important market shifts that we see across the second quarter of this year. So in the ordinary course of events, we'll have a look at what we're seeing across the various states and territories, but we'll also touch on a couple of notable sectors. We'll start with a bit of a whistle-stop tour of what we see at the high level, but please, to Adam's point, please do add questions in the chat as we power ahead, and we'll look to answer as many of those as we can at the end of the overall webinar. But firstly, the 30,000-foot view, what are some of the key themes that we're seeing across the market? Probably need to start by apologising. There's a lot of stuff on this page. I think the team's view is that you can download this and use to socialise more broadly. So you've got all the content there. But for the sake of today, perhaps if you just focus on the stuff on the left that's in bold, and I'll do my best to call out what are some of the key insights as we power through. But at a high level, overall, it's good news. Despite the economic uncertainty and subdued market activity, we're seeing some positive signs. Business confidence has improved over the quarter. The market was anticipating some further rate cuts, and we all saw the good news earlier this week. Overall, we saw a 5.2% increase in commercial credit demand, and you'll see that there on the right side of that slide highlighted on top, but notably for business loans, which was 6% up, with a significant increase in the value of new loan commitments. However, challenges do remain. Insolvencies have continued to rise, and they're now the highest on record. We've seen some delays in trade payments, and so we'll touch on those in terms of some of the increase that we've seen across trade payments and delays of trade payments. And we'll also talk about credit shopping behaviours, and especially across the high-risk cohort of the market, and notably across the high-risk small to medium-sized businesses. With nearly now 1 out of every 2 high-risk SMBs credit shopping, and notably across some sectors in particular, like construction and professional services. And as many on the call will know, credit shopping can sometimes signal that some are finding it difficult to secure credit on favourable terms, or in some cases, to be able to obtain finance at all. We're also seeing a bit of a slowdown in the number of new businesses that are entering the market, as well as an overall increase in the number of company exits, and that's beyond insolvencies. Both of those two factors are contributing towards a bit of a slower rate of growth across the credit active business community. So we'll have a look at that, as well as what we see across a couple of sectors in more detail. So you'll see some of those outlined there on the slide on the left, notably including construction. So we'll do a bit of a deep dive on construction, as well as the retail and hospitality sectors and professional services. In addition to looking at sectors, we'll also highlight how things are playing out across the various states and territories, and notably with Victoria, that's continuing to show some subdued activity, and especially across Victorian small to medium-sized businesses and also across construction and retail. But outside of Victoria and the Northern Territory, the rest of the country is experiencing a strong increase in credit demand, and mainly spurred on by the appetite for business loans. But we didn't see the same play out across either the appetite for capital or for trade. And so we can see that in terms of the subdued growth rates across both asset finance and trade credit. The asset finance numbers actually might have surprised some of you on the call, given the rate drops and typically the end of financial year sales, but also partly reflects the underlying business conditions that we've seen across Q2, with weaker trading and profitability indices, despite the business confidence improving. However, business loans, the inquiries there are strong, and you'll see there on the bottom left of this slide, notably across the non-bank lenders, Tier 2, the Big Four, which have all seen an increase in commercial credit demand and inquiries. We've also seen trade credit inquiries slightly up, more subdued in Victoria and New South Wales, but Queensland and the rest of the country would have certainly seen a slight improvement and higher volumes in that space. All in all, Q2 ended on a positive note. Credit demand is up, business confidence is up, and while business conditions remain subdued, June in particular as a month showed a strong rebound with some positive signs going into Q3. So we've spoken a little bit about what we see there across the market for commercial demand. But when we look at what's happening across risk, and in particular what we see across the credit quality trends, the median position was holding steady over the quarter. While the credit quality across business loans did see a minor uptick, the scores across both asset finance and trade credit showed a small decrease year on year. Slightly lower than the scores actually from the end of 2023, but the good news is the long-term trends remain relatively stable. If we compare to what it looks like about 18 months ago, the credit providers across and or providing asset finance and in the trade credit space may have seen a slight increase in the proportion of their portfolios that have scores below 700, whereas in the business loan space, funders may have seen a small increase in the proportion that have higher credit quality applicants showing interest. From an overall perspective, while we've seen a slight increase in risk across the more vulnerable businesses in the market, the median credit quality was steady and broadly consistent with long-term trends. So good news, credit demand is up, and overall the credit quality is holding steady, but it's not consistent across all states or sectors. It's also not consistent across different size businesses. And so we continue to see a noticeable difference between large and smaller businesses, both in terms of their credit demand, but also in terms of their credit quality. Overall demand for and by the small to medium-sized businesses was just slightly in the red, dragged down notably by Victoria, which was 3% lower than last year. But Q2 did see a strong recovery on Q1 with some positive signs, and notably for small to medium-sized businesses, the demand there you'll see on the bottom right chart, you'll see that it's trying to play catch up to the larger business demand for commercial credit. But some of that also does partly reflect what we're seeing in terms of some of the credit shopping behaviours. So we'll talk about that a little later. But overall, we're continuing to see a small difference between the average credit quality or scores between larger businesses and smaller businesses, but both relatively stable over the last few quarters. For most of you on the call, I'd anticipate you're seeing growing levels of demand across the small to medium-sized businesses across the market, again with the caveat perhaps not so much in Victoria. but especially from small to medium-sized businesses with relatively stable credit quality, at least at the median level, and again, excluding that lower subprime part of the market. So we're seeing credit demand up, the median credit quality broadly stable. Unfortunately, insolvencies have continued to rise, highest on record. Overall, insolvencies were 16% up on last year, with Victoria and the Northern Territory seeing the largest increases. The largest contributors in volume terms continue to be by state, New South Wales, and by sector, the construction industry. And again, some encouraging signs there. We see both starting to show a bit of a slowdown in the rate of increase of insolvencies. But hospitality as a sector, it was 28% up in terms of the insolvencies in that sector, and now has, if you have a look at the chart there on the bottom right, unfortunately an insolvency rate that's in excess of 3% of all credit active businesses in that sector. So given the elevated level of insolvencies, it would be good to be reviewing your risk monitoring activities and ensuring how you're using alerts and portfolio health checks and more detailed due diligence for your larger and or higher risk exposures. Now, while many on the call will arguably have some less direct exposure to insolvencies, a couple of you may have seen or experienced late payments across your portfolios. A review of the trade payments across Q2 shows that the average days beyond terms have deteriorated slightly, especially across SA, New South Wales and Victoria, and across the continue to remain at elevated levels. And again, a bit of a prompt to consider your risk monitoring activities accordingly. Okay, so time to review a couple of industry sectors in more detail. We'll start with construction. It does tend to be a sector that does attract a lot of attention and is certainly viewed by some as being high risk. But it's also really important because the impact it has across a large number of adjacent sectors in the market, as well as the overall economy. So probably important that we start with a little bit of context behind some of the drivers and what we see in the construction market overall. So coming out of Q1, many on the call, we're familiar with the fact that we saw the building commencement data trending up, and especially for apartments, so that was good news for residential, although the actual building work done was overall relatively flat. We saw that it was up in resi, down in non-residential or commercial, and engineering or heavy and civil was only slightly up. At the time, the private CapEx numbers, so capital expenditure, that was relatively flat. However, Q2 did see the capital expenditure intent improving on the back of forward orders, which were up, and also project pipelines. And June in particular, in part saw a construction confidence and conditions both improving. So to this slide, for the first time in a long time, we've seen an uplift in credit demand for construction, scraping into positive territory there. You'll see there on the left, and supported by larger businesses. And again, a general business loans demand in particular. We haven't seen that play out across capital or trade. Asset finance was just shy of 5% down on last year. And we also did see demand from small to medium-sized construction businesses was still subdued. But we saw an increase overall in terms of business loans, and especially across the non-bank lending segment. That was about 10.3% up, see there on the bottom left, with larger construction businesses also showing strong interest in securing credit from the Big Four. That was 8.3% up on last year. The chart there on the bottom right, again, just painting a bit of a picture of how do the actual credit scores compare across different size businesses across those products. But good news is the median credit quality remains broadly stable. Having said that, we have seen increased risk in the lower subprime space of the market, which in construction is about 1 out of 5 businesses that are credit active across the market are showing that high levels of risk, and notably across those that are seeking capital and or asset finance. Unfortunately, construction continues to see an increase in the insolvencies. And while being only 12% up on last year, the good news is that the rate of increase has been slowing. But the elevated capacity utilisation numbers show that demand is continuing to be in excess of capacity. And we know that labour supply is still, an issue, an ongoing issue. And we've seen a deterioration in the financial capacity metrics for residential in particular, constrained as a function of the profitability numbers that we're seeing across that sector, and notably across Victoria. While there's a small improvement there, you'll see on the chart on the top right for the trade payment days and the data there, the days beyond terms in construction are still elevated at more than 2 times the market average. But the good news is they are holding steady at a general level with a slight positive improvement, supporting the view in light of all the data that we're looking at, that we're entering that repair and recovery stage of the credit life cycle for the construction industry. Okay, so picking up the pace, we'll cover a couple of other sectors, importantly looking at the hospitality industry. And as you know, that covers accommodation, hotels, cafes, restaurants. But it's a sector that has been under a lot of pressure and on the back of increased trading costs, which have been rising, but also relatively subdued demand. So the consumer spending, given the cost of living pressures, the credit demand for these businesses was relatively subdued, as you'll see there on the left, across the country, with a small call out, except for Queensland, which showed some growth. We saw an increase in credit demand from the small to medium-sized businesses, also called out there on the left, especially for trade credit and business loans, with lower demand seen in terms of the appetite for capital in the form of asset finance. But we also saw a significant increase in credit shopping in this sector, and we'll pick that up again a little later, and especially across small to medium-sized businesses in the hospitality industry, which can signal difficulties. So as I'd said, it's a sector which has been under pressure. The insolvencies were 28% up on last year, and now has an insolvency rate of in excess of 3% of all credit-active hospitality businesses. Looking at the data in a bit more detail across the quarter, we did see a bit of a pullback in activity in May after the bump of Easter and the school holidays in April. However, it was encouraging to see a slight improvement in the average trade payment days, which showed a slight improvement in Q2 in average terms, but again, elevated risks at the lower subprime end of the market, and in a way that's not that dissimilar from the proportionality that we see in the construction industry. In hospitality, it's also relatively similar. About 1 out of 5 businesses are showing high levels of risk in the hospitality sector. Moving on to the retail. All right, so we've seen businesses having a relatively positive trajectory in this segment, especially on the back of retail sales growth, which is good. However, it is a complex environment. There's some nuances across this market in light of the cost of living pressures that are reshaping spending habits and patterns. And consumers have been a little bit more cautious and selective. And as such, businesses have also been more cautious, with relatively subdued numbers in terms of the overall credit demand. You'll see that there on the left, and especially for Victoria, which was 3% lower than last year. However, overall, we did see a stronger demand for business loans over Q2, notably by the small to medium-sized retailers. While retail insolvencies were only marginally up, so about 4% on last year, the early provisional data for trade payment days signals growing cash flow pressures across the sector. So you'll see that there in the chart on the right. The team have been hard at work finalising the end position of the provisional data, and anticipate that's going to come down a little, but still likely to be around 3.5 days, still up on prior periods, and still a bit of a concern. So for those of you with credit exposures across the retail sector, important to continue to monitor closely trade payment performance. Be good to keep a close eye on the days beyond terms. Okay, on to professional services, which is a really interesting sector. A lot of businesses operating in this segment, and anticipate many on the call will have some activity with or credit exposure to businesses in the professional services space. We've seen a strong increase in credit demand. You'll see there on the left, especially for larger businesses, that was 10% up, and notably for business loans, which saw demand from large businesses up 11% versus only 5% for small to medium-sized businesses. We also saw a strong increase in appetite for capital. Asset finance was 7% up, but more subdued activity across trade credit and credit demand for trade credit. However, it's a cohort that remains under pressure. We've seen the trade payment days increase over the quarter, and solvencies were 26% up on last year. Fortunately, these are still relatively small in proportion to the overall number of credit active businesses operating the market. So it's less than 0.5% of the credit active businesses in that sector. So again, trying to ensure that there's some relativity to those numbers, but directionally, showing some signs of stress. Prudent to keep an eye on the rise again in terms of days beyond terms for exposures in that particular sector. So look, that's a quick wrap. We've reviewed a couple of sectors. Hope that's been of interest. But now I want to shift gears as we dive into how the business volumes and the numbers are sort of changing over the last year based on the number of new entrants into market as well as company exits, with many of our clients expressing strong interest in wanting to understand how the overall market is performing, activity levels in terms of the number of businesses, what's been the movement in the number of businesses across various sectors. So we'll spend a couple of minutes looking at these, as well as covering off on some of the latest insights around credit shopping behaviour. Firstly, on to new entrants, which have pulled back quite a bit over last year. We're seeing 9% fewer new entrants in 2025 for that fiscal period, relative to the number of new entrants we saw in 2024. We've seen that play out across a lot of sectors, and especially or notably across professional services. That saw a reduction of 42% in terms of the number of new businesses entering the market relative to the number of new businesses that entered last year. Hospitality, we saw 20% fewer on last year, and across construction, we saw 13% fewer new businesses entering the market. And so all in all, a smaller number or a slowdown in terms of the number of new entrants coming into the market relative to the prior year. On the flip side, we've actually seen more businesses leaving the market, with an increase in the number of company exits, which tracks those businesses that are leaving the market beyond those that have gone into insolvency or external administration. Overall, company exits were 12% higher relative to the number of exits that we saw in 2024, and notably across construction, which had nearly 14% higher in terms of the number of exits to last year. Retail was 13.5% up, and hospitality was nearly 11% up. And so with the number of new entrants down and the number of company exits up, we've seen a significant slowdown in the growth of the number of credit active businesses overall, which has seen an overall increase there, if you look at the chart, just over 3%, and nearly a third of the increase that we saw in 2024. Importantly, some sectors have seen a real shift in the underlying makeup of their industries, and some industries in particular have also experienced a significant turnover, such as construction, which is called out there for you on the left, which has 40% of the companies in construction being new within the last 5 years. So that's entries, exits, and the changes that we're seeing across the number of credit active businesses. If we pivot now and have a little bit of a look about what we're seeing across the credit shopping behaviours and patterns, which over the last couple of years have been on a bit of a downward trajectory, and you'll see that there on the chart on the left. But we did see a bit of a rebound following the first rate cut earlier this year, notably across the high risk borrowers. So if you have a look there at the chart on the top right, you'll see there that the credit shopping behaviours have remained relatively stable across medium and or lower risk borrowers, but we have seen an uptick in terms of some of the credit shopping activity by the high risk cohort, being those that have got Equifax scores below 600. While the average score of the higher risk applicants seeking credit has remained relatively stable over last year, we've certainly seen an increase in the credit shopping across some within this group. So I think the higher risk cohort represents nearly 14% of the market, higher for some sectors. We've mentioned construction and hospitality both being closer to having 1 out of 5 businesses of the credit active market being that high risk cohort. But we've seen a real increase in credit shopping across those 2 sectors in particular. And for construction, more than half of this group was actively credit shopping across Q2. So continuing on that same thematic, while we've seen larger businesses being 10% less likely to credit shop than 12 months ago, nearly 1 in 2 inquiries from higher risk SMBs are credit shopping, notably across certain sectors. If you have there a look at the charts on the left by sector, you'll see that smaller construction businesses in particular have seen a 25% increase in credit shopping and now have effectively 3 out of every 5 of those in that cohort shopping for credit, signalling that they may be finding it difficult to obtain access to credit on favourable terms or to access finance at all. So that's a wrap on what we're seeing across the market in Q2, at least at a high level. Overall, good news with an increase in credit demand, some positive signs, while credit quality remains broadly stable, at least at the median level, and we're seeing pressure remains particularly across the lower subprime space. We've seen delays in the slight uptick in days beyond terms for trade payments, so we touched on that, and also spoke a little bit about what we see in terms of some credit shopping behaviours, and especially for higher risk small to medium-sized businesses. We spoke about the increase in insolvencies, that we're continuing to see those rise at elevated levels, but also did mention a bit of a slowdown and some early positive signs that we're seeing there. We also touched on the slowdown in the number of new businesses entering the market, as well as the increase in the number of company exits, again, beyond insolvencies, contributing to the overall slowdown in the rate of growth that we see for the number of credit active businesses across the community. At a state level, we mentioned Victoria was still showing some difficulties, and we also touched on a few sectors. But if you'd like further details around how we can best support you in navigating the nuances across the market more broadly, please reach out to your account managers. They'll be happy to help. On that, I'll hand back to Dave. To Adam.
Thanks, Brad. And guys, just a reminder as well, I know we've got a couple of questions through. If anybody does have any questions, please go to your Q&A box down the bottom there, and we'll get to as many as we can straight after Dave. So thanks, Brad. Really appreciate that. And you know what? Leaning into those insights that Brad has just walked through, I think it highlights the continued laser focus that risk managers need to have on the health of their portfolios. So whether that be identifying significant risk matters such as defaults and risk score deterioration, or understanding company ownership and potential changes to those ownership constructs over time, all of which could both pose credit and compliance risks to your organization. So with that being said, I'll now hand it over to Dave McCulley, our head of commercial solutions here at Equifax, to talk to you about solutions that may help your companies manage those risks, as well as being ready for potential CPS 230 and AML Tranche 2 obligations. So thank you, Dave. Over to yourself.
Thank you, Adam. Appreciate that. Okay, so a couple of key topics I'm keen to talk to you about today. The first one being CPS 230. If we could get you to move to the following slide. So CPS 230, as you can see, is a prudential standard. Effectively, it applies to those organisations which fall under the regime, or if you will, the regulation of APRA, and it is a operational risk, more focused prudential standard than probably some of the ones we're more familiar with, which are more the credit risk focused. The whole idea around the CPS 230 Act is for the regulator to ensure that organisations that are effectively authorised deposit taking institutions have much stronger, more robust operational risk management frameworks. And there's a lot of work involved for an organisation that does now have a requirement under CPS 230. There's a number of things around understanding their operational risks from a business continuity planning to a disaster recovery standpoint, but also there's a much greater onus now on the robust monitoring of those suppliers that help them with their critical business operations. Get you to move to the next one. So as you would have seen on the previous slide, it's effectively went live, the Act, on the 1st of July this year. However, there is a 1-year transition period that has been provided to those organisations to effectively get the house in order and get all their plans and processes in place. We obviously, it affects us in a couple of ways here at Equifax. One, we are a critical supplier to a number of businesses that have, obviously a lot of the businesses that fall under the Act, a lot of businesses of, obviously of customers we have here today. But also we can actually help those organisations, and we are working with some as we speak right now, getting their house in order in terms of getting the systems in place to monitor those risks on an ongoing basis. Move to the next slide. In terms of the information that we are primarily working with our clients around is the stuff that you can see here. So it's whether you've got changes. So obviously you're monitoring your suppliers, but what's happening with the suppliers? Is their risk profile looking good from a score standpoint? We can support that. Obviously ASIC information, ATO defaults. That's all very important information that an organisation needs to understand around their suppliers and whether they pose any risks to their ability to perform their daily activities in terms of running their own organisations. So what I'll do is in the following slides is just touch on a couple of the key things that organisations are focusing on, and we're supplying them with information. Look, here's a slide probably some of you have seen in previous iterations of collateral, etc., that Equifax provides. This is the old risk scores. So from a portfolio management standpoint, we can provide our key customers and our pre-regulated entities weekly scores to help them understand the risk of their books. So obviously if one of their customers, and you'd like to think most of their suppliers, I should say, are sitting in those nice green score bands, but if their risk profile starts to deteriorate, and that's obviously based off bureau activity and information that we see here and feed through to our scores, then it obviously would enable the op risk functions within these pre-regulated entities to obviously understand what activities they need to place on their important suppliers to make sure that they're going to continue to operate and serve them as they require. Move to the next slide, please. You saw before on the other diagram, what other bits of information are we sharing with them? Well, you can see here, whether there's changes in their financial constructs, whether there's obviously credit default or court actions, which would be quite concerning for an organisation, changes to shareholders, office holders. I mean, that's sort of bread and butter for them from their credit portfolios on their AML risk obligations. But clearly, this is also now falling under the prudential standard for operational risk too. Changes to company status, deregistration, exit, etc., would be of great importance. And obviously other things that we sort of touched on before around trade data, where there's deteriorations there, signs of stress, and key information around company details, whether there's certain industry codes that they are aligned to. So are they in certain industry verticals that are posing higher risk, and if so, then those organisations need to take action to address those. So so just wrapping up finally on that one is we can supply that information. There's many ways in which we can get that information to you and your organisations, or to our key clients who are getting ready for CPS 230. Like Brad said before, go to your account manager. They can obviously point you in the right direction. We can assist you with any inquiries you may have around ingesting that information and how it can be used by your organisation. The other sort of key regulatory change that we're having a lot of conversations with our customers is around the Tranche 2 of the AML Act. So obviously we're probably all pretty familiar with the current AML KYC obligations. Obviously, I look after the commercial solutions side of our business here at Equifax, and we work closely with a lot of our customers to help them with their know your business. So the company beneficial ownership, understanding who the key people are that sit behind organisations that you're doing business with. Obviously, under AML Tranche 2, that hasn't gone away, but there's been a couple of little changes. So I guess the first and probably the most obvious change to the Act is that I think right now there's something like, I believe it's around the 10 to 20,000 entities. Maybe that's even high side in terms of the numbers that are actually under the Act and currently performing their obligations as required. That's now going to swell to about 5-6 times, with an extra 100,000 participants now falling under the requirements. So as you can see there, real estate agents, lawyers, conveyancers, accountants, precious metals dealers, they all now are going to be required to fall in line and obviously perform those KYB, KYC type activities that effectively finance organisations are doing today. The main changes to the Act is, and I was with a major client of ours last week, a major bank in this country, And there's still a little bit of concern around the prescriptiveness of the Act. So it's a little less, hard, detailed and prescribed than it was. And it's now falling back onto organisations to perhaps better understand their risks and what they need to do. But in saying that, the regulators have come in pretty sternly saying, you've got to make sure you've got the right org structure, org compliance, processes in place to do this. So from what I'm hearing is that those major organisations that are currently under the Act are still consulting with AUSTRAC at this stage to really clearly understand what is required of them. So there's still a little consultation period as we move along. And as you can see on the timeline there, the key date obviously is July 26th, so July 1st next year. But by the end of March, start of April, those organisations that don't currently sit on the Act need to be registered as part of the Act and also have plans in place. So there's a lot of activity going on now with regards to those organisations working out what their requirements are and how they need to be ready for it. Just move to the final slide. And look, in saying, what requirements are required, what information supplies they need. We obviously support a lot of our customers right now, and a lot of you on the call would be using our ASIC information, our company beneficial ownerships, a product that's heavily used across the market. This obviously helps you, rapidly identify who the key individuals are that sit behind these organisations. And then accordingly, once you've identified them, you need to go and identify the personal identities of those owners of these companies. And whilst I haven't covered that and won't be talking to it in this slide, we obviously have an ID team here at Equifax as well. And once again, if you go through your account manager, they can put you in touch with the right expert that can walk you through the undertakings that you might need to put in place for the Act as we go towards a live date at the end of July next year. So yeah, that for me is a quick update on those two key regulatory changes that are impacting us and our customers, and some of the solutions that we may have that can assist you as you move through the journey to getting your house in order and being compliant.
Awesome. Thanks, Dave, and thanks, Brad, too. We do have quite a few questions coming through, so I'll jump straight into some. There were quite a few about the deck itself. Well, we get a copy of the deck. Absolutely, you will all get a copy of that. Couple of quick questions, Brad. I might start with a couple for yourself. When you were talking about the insolvency numbers, just wondering how they compare to the pre-COVID numbers, and do you think that we've just simply seen a correction?
Thanks, Adam. A good question. In essence, we've actually seen everyone on the call might recall when we first went into the COVID period, we actually saw a significant reduction in the number of insolvencies that were being recorded. And that was in no small part to the temporary relief mechanisms that were made available across the market. But since then, we've certainly caught up, and in some cases we've overshot. So to give the people on the call some historical sort of context for where the numbers today relative to where they used to be, the numbers are about 1.5 times higher up across the market overall, excluding the construction and hospitality industries. If we look at just the numbers for hospitality and or for construction in particular, construction is 2.3 times higher than the pre-pandemic levels. So if you look at the 5 years prior to COVID and compared to the numbers that we see today, in construction we're 2.3 times up. And into 2021, many people on the call might know for construction we ended up being about 40% lower than historical levels. So not only have we caught up on that gap, but we've actually well and truly overshot. And we've seen that play out across some of the different states a little differently. New South Wales was about 2.7 times up. ACT was nearly 3 times up. Victoria 2.4 times up, and that's still growing. So it's great to see the slowdown in the insolvency rates, but they're certainly at elevated levels.
That's great. Thanks, Brad. And look, just while you're on that, AMA has, sorry, I forgot your name wrong there. I believe it's AMA. I see a lot of businesses applying for smaller business restructure without entering into liquidation or bankruptcy. However, this is not helpful in terms of collecting the overdue balance, as it limits our action to take legal action. What are your suggestions on how to avoid before this goes ahead? Interesting question. Look, again, we wouldn't want to be seen to be giving any legal advice, but maybe that's a good question to reach out to your account manager, and we'll circle back offline. Thank you. I might pop to one for Dave now. Dave, how do you know if your organization needs to comply with CPS 230?
If you're an authorised deposit taking institution, that is probably the obvious reason why you would need to fall under it. If you were an ADI, you would absolutely be aware of your ongoing obligations to APRA on a bunch of other prudential standards. So that would be the obvious thing. But if not, definitely I would inquire with APRA and understand where you stand on that one.
Great, thank you. Dave, just I guess a bit of a similar one. From what you're seeing in the market, what key activities are companies with a CPS 230 obligation undertaking now in readiness for go live in 2026?
Look, there's a lot going on. I think one of the key things, I may have sort of briefly touched on it, but they're very much spending a lot of time understanding their key business activities, so documenting those, which you would think the larger organisations would probably have a pretty good handle on from their disaster recovery plans, their business continuity plans that they'd have in place. From that, though, they are obviously working out who the key suppliers are, and then from that, the next step, I guess, is understanding what the acceptable SLAs for those suppliers are. So it varies depending on the type of support or activity that those suppliers provide. We at Equifax as a credit provider usually sits fairly high in terms of lending, business continuity planning stuff. So obviously, when someone applies for a loan, they want to have access to us. So we need to be up most of the time, all the time, and that's one example. But it varies depending on that. But they have to document that and understand that. The other thing is there's a lot of consultation. So as I said, our key, a lot of our customers are talking to us right now. So we're working with them in consultation around what they require from us in order to get their plans and processes in place. And then, I touched on the ongoing robust monitoring of the health. So what we're seeing is a lot of thorough financial analysis, a credit assessment activity is taking place, if you will. So, a number of people on the call are probably aware of our ratings business that we have, FVR, Financial Viability and Ratings. They're effectively performing full financial viability assessments on key suppliers on behalf of our larger customers. And you could almost say that's stock type work. So getting the stock and understanding the base of how the suppliers look, and then to the solutions that I talked about, which we call flow. So taking those alerts, taking that any new information to have those robust mechanisms in place to understand if something's changed that could affect you. And then finally, one of the ones that's the bit of a challenge for a lot of companies is where do you house it all? So solution providers identifying those organizations or system providers that can give them a one-stop shop where they have the dashboards and they receive all the alerts. So that's one of the key ones, and I think that one will continue to ramp up as we move towards the middle of next year.
Look, I might just add to that too, Dave.
Yep.
In terms of I guess for listeners on the call, whether you're covered under regulatory obligations or not, I think COVID certainly did amplify the importance and the need to be really looking through and understanding the supply chain resilience. And I think there was a lot of challenges that operationally that have impacted a lot of businesses throughout that period. So I think it's really elevated the focus and the attention around that value chain management, and particularly around that supply chain, understanding the key suppliers, the key counterparties, and what's the risk profiles and how can that actually impact respective businesses and their strategic objectives. So I think, again, probably just circling back on an earlier question, what does CPS 230 specifically cover? I think the counter to that, I would suggest, is that it would be prudent for a lot of businesses to be thinking about how they're actively identifying and then monitoring and managing where needed, elevated levels of risk across their broader supply chain.
All right, thank you both. Another quick one here. Brad, professional services, interesting to see the insolvency rate increasing in this sector. Do you have any insights as to why this might be the case? Traditionally, SMEs operating here don't have big lending requirements versus other capital-intense sectors.
Yeah, that's true, and a good call out. Look, again, I'd probably just reference the fact that in the scheme of things, it's still a relatively smaller percentage to the total number of credit active businesses in the market. But what I would say is I probably don't have any immediate data on hand to specifically talk about the underlying pressures for SMBs. But if we look at some of the trends across the larger businesses in that cohort, it's fair to say that many of them have really been reviewing their business models in the new realm of AI and how AI can actually really significantly augment the way in which professional services firms are able to deliver, more outcomes for their clients than arguably they've ever been able to do before. And as a result of that, there's been a number of them re-engineering their business models to really reflect or accommodate some of those disruptive shifts that they've seen across the market. So I don't have any data for the small to medium-sized end, but presumably that's going to have a part to play in a fiercely competitive and fragmented market in that professional services industry for SMBs.
Thanks, Brad. Look, possible question for Dave, maybe for both. What tools do you have to assess credit risk where business is new and the ABN is new?
Well, I mean, the credit scores that we have, our credit reports, they can still work off a number of key pieces of information that are provided in the actual application, and what we see, and can benchmark against similar ones. And obviously, from that benchmarking, we have historical models built off that benchmarking to identify what the likelihood of risk is. But yeah, I mean, look, from a credit bureau standpoint, there we have the obvious information, so it's the ASIC information and the linkages. So I encourage if you look at the director, if they're new to business and there's not much there, then you obviously got to look at the individual that sits behind it. But conversely, if there is historic directorships in other companies, then we do have the information that can help you as part of the assessment process that can look at those linkages and understand whether there's any sort of skeletons in the closet that you need to be concerned about.
Which is really important to be able to capitalize on the data that's available around both people and businesses. Mm-hmm. And so where there is a new venture, to Dave's point, it's really about understanding who are the key persons behind that new business and what's actually been their track record in the past of other businesses that they've had an affiliation with. So it's leveraging that Equifax data set to really understand what's been their sort of past performance, their past conduct, as informing and influencing the credit decisioning and risk profiling of newly established ventures.
Yeah, and I'll just add, Brad, my team, the commercial specialists here at Equifax, work with Adam's team and a number of our account managers, and they can absolutely sit down with you and work through what is the best type of information you should be pulling as part of your credit risk processes.
It's great. Look, we do have a lot more questions coming in, so I'll tell everyone now, I don't think we'll get a chance to get to all of them, but what we might try to do is answer a lot of these as we send through the documents send through a copy of the recording through and that kind of stuff. But look, we'll keep going with a couple more for now. I know, Christine, you've got a few. Has the lead time between the first default and insolvency changed post-COVID?
Look, that's a good question, Christine. I don't actually have that data on me readily available, but it might be a good one that we can take away and circle back on.
Yeah, thanks, Brad. Okay. There was one here, and I do apologize. It says, what are the main factors driving this increase? I'm not sure which increase it was. That was a question for Brad. Is it interest rates? Is it inflation? Is it credit tightening? But I'm not sure what the question was specific into which increase.
Well, look, the big increases that we've spoken about probably are really around the construction industry and hospitality. So I'm not sure if it might have been about one of those, but if we talk about construction as an example, what's contributing to it is just the difficulty in that segment. And so I think it's fair to say that they're continuing to have a significant demand placed on them in terms of their project pipeline, but they haven't had the resourcing to be able to effectively execute. And we've seen that play out in the underlying data sets of demand and capacity. And as a result of that, it's also had an impact on the underlying financial fundamentals of a lot of businesses across the construction sector, and notably residential as one example, which has really seen continuing to see sort of subdued levels of profitability, working capital, and cash reserves, and notably in Victoria. So again, I'm not sure if perhaps that was the question was around Victoria in particular. But when we look at the difference between financial capacity and financial viability is really looking at the ongoing concern, the ongoing viability of a business in the ordinary course of events, whereas financial capacity is looking at its capacity to actually honour its contractual obligations in the form of its project pipelines. And what we've seen, again, looking at residential, is their pipelines have been growing. That we spoke about that a little earlier in terms of the forward pipelines. but they haven't been able to execute on those pipelines. And so there's some financial pressures that's been imposed. Given the labour constraints on those businesses, we've seen a deterioration in their profitability and their working capital metrics and their cash reserves. So there's some of the reasons that are playing out, but it's nuanced. It's different across different states and across different sectors. So it's a difficult one to answer in aggregate. But what is encouraging is that we are seeing some positive signs, especially going into Q3, and it's good to see that credit demand is up. And for some sectors, it's good to see some really healthy signs playing out.
Thanks, Brad. There's a couple of very industry-specific questions coming through, so we'll see if we can get through a couple of them. Again, this might be something that we can also provide some further and deeper insights on to the individuals that are asking this later on, especially if you do have more questions like that. Again, feel free to add them in your survey. We'll go into one now from Dave. Any insights on the transport sector at all? There seem to have been a number of medium to large business failures / closures in recent months. It feels like viability is being challenged for some really established companies.
Yeah, it's interesting, right? Because I think historically, looking at periods of economic stress and pressure, construction and transport logistics do tend to sometimes be a bit of a litmus test of the pressure that the market is under. I don't have any tangible hard data in front of me at the moment around some of the underlying fundamentals for the transport sector, but it's something we can certainly take a look at. It's a great opportunity to reach out to your account manager and hit them up with some questions, and we can circle back and respond to those.
Awesome. So look, there were a couple more. I know we're about 7 minutes slightly over the anticipated close, but if anybody does have any more questions, it does come on the survey and we'll reach out to those individual ones as well. Those that have asked a question on here will reach out to you as well. Please don't forget that survey to be able to come in if you would like to know any more information, if you would like to see any more information. Would love that feedback to be able to take on. So really appreciate everyone's time today. Have a really good afternoon wherever you are. If you're in Sydney, hopefully the weather clears up a little bit, but it's not looking great out there. Thanks everyone for your time. Really appreciate it. We will see you on the next one.
Thank you, everyone.